Develop a trading plan and stick to it. In trading, a trading plan is like a strategic blueprint that guides all your actions. It's a detailed document that encompasses various aspects of your trading approach, including your chosen strategy, the conditions for entering and exiting trades, how you'll manage risk, and your overarching financial goals. Why is this important? Without a plan, trading can easily become a chaotic and emotional endeavor. Traders who operate without a clear plan are more likely to make impulsive decisions driven by emotions like fear or greed. These impulsive actions often result in losses. A well-structured trading plan, on the other hand, provides you with a clear framework for decision-making. It defines your trading strategy, which could be based on technical analysis, fundamental analysis, or a combination of both. It lays out the specific criteria that must be met before you enter a trade and the conditions under which you'll exit, whether to take a profit or cut a loss. Furthermore, a trading plan helps you manage risk effectively. It includes risk management rules, such as setting stop-loss orders, which limit the amount you can lose on a trade, and position sizing, which determines how much of your capital to allocate to each trade. These risk management techniques are crucial for protecting your trading capital. However, having a trading plan alone isn't enough. You must also stick to it religiously. The discipline to follow your plan even when emotions are running high is what separates successful traders from those who struggle. It ensures that your decisions are based on a well-thought-out strategy rather than impulsive reactions to market movements. In summary, developing and adhering to a trading plan is a fundamental practice in successful trading. It provides structure, helps you make rational decisions, and minimizes the impact of emotional trading. It's a critical step towards achieving your trading goals and long-term profitability.